Let's get started on our second presentation for financial ratios and ratio analysis. And for this presentation, you're going to want to have the formula sheet handy. And so it's on the website and in Canvas. Here are the common stock ratios that we looked at in our previous presentation. And here are the ratios we're going to take a look at today. Profitability ratios, liquidity ratios, activity, and leverage or solvency ratios. And notice that the formula sheet also tells you where to find the data that we're looking for, either on the income statement or the balance sheet or both. Okay, so make sure you have that. And it also makes sense to have the financial statements printed out. It's up to you, right? You can look at them on the screen, but I think it's easier to print them out. So let's get started. Slide 21 with the profitability ratios. Now, a few of these you often will find on Yahoo Finance or MarketWatch or CNBC, Morningstar. So you can check them out. But most of the ones we do today, we're going to have to do our own calculations. Folks, all you need is a 99-cent calculator. All right, it's not that hard. So the profitability ratios measure a firm's returns by relating profits to sales, profits to assets, profits to equity. And as I said, some of these are very important and you see them reported in the financial media. The net profit margin, the gross margin, the operating margin, return on assets, return on equity, and return on invested capital. Profitability ratios allow one to measure the ability of a firm to earn an adequate return on sales, total assets, equity, and invested capital. So slide number 22. The net profit margin, also called the after-tax profit margin. This one is the rate of profit being earned from earnings after expenses and taxes. So what we do is we take a look at the net income, the bottom line, and we divide it by the total revenue, the top line, right? You've heard these terms, right? The higher, the better. Of course, it varies greatly from industry to industry. Now, I've got my cheat sheet here. I've already done my calculations, but you got to check me because I make mistakes, okay? I goof up. So remember, net income and total revenue. Now, where would we find those? Well, the formula sheet would tell us we need to look at the income statement. So let's take a look at the income statement here. And here's that total revenue number, $7.7 billion. 7.7719290. And what's the bottom line number? The net income, 380,601. So when you take 380,601 divided by 7719290, where's my cheat sheet? I get a net profit margin of 4.93%. Is that what you got? Is that what you got? Maybe yes, maybe no. Check it out. Maybe I made a mistake. Now, that's almost 5%. Is that good? Is that bad? Oh, I don't know. Yeah, we have to compare it to other grocery firms. We have to compare it to the competitors and the industry they're in. And the problem with this is who are Sprouts' competitors? Well, you've got Kroger and Safeway and H-E-B, which is private, but they're not. They're more mainstream grocery firms. What about Whole Foods? Well, Whole Foods is owned by Amazon, so they don't have a separate financial statement that we can look at. And how about Trader Joe's? Aldi's? Oh, they're privately owned by Aldi's, which my understanding is they might go public soon. They're moving their headquarters from Germany to United States. So we'll see what happens with them. But that's the problem with Sprouts. It's kind of it's a niche market up mostly against companies like Whole Foods. So we really have to be careful who we compare them against. But that's not bad for, in my humble opinion, for basically a dull normal business. They're groceries. Yeah, it's not that exciting. Yeah. So that's the issue. The higher the better, but we have to compare them to their competitors. Now, what about the gross margin? Well, we take out the cost of goods sold and we get the gross profit. And so we need to go back to our income statement. So let's go back to our income statement here. Where's the income statement? Come on, where'd you go? There it is. And we see that taking out the cost of revenue, or sometimes you'll hear people say cost of goods sold, we wind up with 2.9 billion. 2,941,491. So we divide the bottom line number, 38601, divided by the 2.9 or 2941. Make sure you do it. Come on, do it. Make sure you stop the presentation, pause the presentation, and run your calculator. And what did I get? I got a gross margin of 38.1%. That seems a little high, doesn't it? No, actually, no. For a retailer, that's basically what you want, folks. You want about 30-40% gross margin. Yeah, and that makes sense, right? When Whole Foods, well, in Sprouts Family Market, when they buy things, they don't buy one, right? They don't buy one thing of Pampers or one thing of a bag of avocados. They buy tons of this stuff, and so they get a huge discount. And so when you go into a grocery store, and not everything, some things have a very much lower margin. When you go into a store, it's typically that they are spending about 30%, 40% less than what you're spending, because they're buying 100,000 Pampers and not two. And so that makes sense. And you think, well, that's not fair. Well, wait a minute. We haven't exactly. We haven't taken out all the overhead, as it's called, or burden, or SG&O, sales all the expenses it takes to run the place. And so we have to look again at the gross margin for other retailers and find that I think 30% is pretty darn good, and they got 38%. So again, we have to look at their competitors and see what's going on with the industry they're in and their competitors. Now, operating margin is the rate of profit being earned from operating income. So here we go. Now we're going to take out the SG&O, right? I'm sorry, I clicked on the wrong. Here's the formula sheet. I meant to go down and get the income statement again. And so here we have to take out sales, general and administrative, SG&O, SG&A, take out all the rent and the payroll. And so the operating income is 504,497. So we take the 504,497 divided by the total revenue of whatever it was, some 3 billion, no, 7 billion, 7.7 billion, and we get 6.54%. Well, yeah, you guessed it. The higher, did I say to divide in the previous one by the net income? No, I apologize. You divide by the total revenue. My apologies. That doesn't make any sense. I hope I don't remember now, but I think in the previous slide I used on the bottom net income, and that's not right. Total, it should be total revenue. Let's go back and check. Make sure. Yeah, see, gross profit divided by total revenue. My apologies. Operating income divided by total revenue. All of them are divided by total revenue. And so 6.54%. So that's after we've bought all the items that Sprouts has sold and then paid all the overhead, as it's called, or the sales, general and operating expenses. And we wind up with about 6.5%. You guessed it, the higher the better, and it varies greatly from industry to industry. So when we are looking at a specific company, we always need to look at its competitors within the industry. When we find a company that is atypical of its competitors in the industry, as we did in the previous presentation where we saw some companies with PEs very different than their competitors, it's a signal that we have more investigative work to do. It doesn't necessarily mean we should buy it or not should buy it, should not buy the company. It's just a signal to do more research and understand why British Petroleum had a PE of 250 and the other energy companies had PEs of 15. Okay, now here we're going to move away from comparing it to the revenue and then comparing it to the assets. So here the return on assets is a measure of how profitable a company is relative to its total assets. So we take the net income and divide it by the total assets. Return on assets looks at the amount of resources a company needs to support operations. It reveals how effective the company is in generating profits from the assets it has available. Of course, the higher the better, right? But we have to look at their competitors. So now we need the net income, the bottom line from the income statement. And what was that, 380, 160 or something like that? And now we go to total assets. Well, where's the total assets? That's on the balance sheet. So we have to run to the balance sheet and look for total assets. So here's the balance sheet. Total assets, 3.64 billion, 3,640,669. And we divide that into the net income, which we saw was 380, 160. What was that? Do you remember? I don't remember. 380,601. I'm sorry, 380,601. So what I get as a total return on assets is 10.45. And that's, I think, for a very boring business such as Sprouts, I think that's actually pretty darn good. And I think that's why their stock has been doing very well of late. Now, return on assets shows how profitable the company is relative to its total assets. Return on equity says, let's get rid of the debt. Let's do the exact same calculation, but instead of comparing it to the total assets, let's compare it to just how much of the company is owned by the shareholders, the total stockholders' equity. Because the return on equity uses return on equity, yes. Because return on equity uses stockholders' equity instead of total assets for the denominator, return on equity is sensitive to the amount of debt a company is carrying. Specifically, if a company carries a great amount of debt, return on equity will be much larger than return on assets. And you'll hear this saying, especially in the real estate world, but definitely in the business world also, you are using other people's money to make your money. Now, it's a two-edged sword. Some investors view this positively, but you're taking on debt. Others, myself included, are worried about the possible negative consequences of too much debt. My motto has always been make love, not loans. Well, you know what? That's not always the case. A lot of times, debt is a good thing because it helps you get from point A to point B and build new factories or open new stores in new markets or whatever. But still, you got to pay it off, right? You got to make sure you earn enough money to pay the debt off, to pay the interest payments. And then when the debt comes due, you have to pay it. And what we're going to find is that Sprouts is sitting in the catbird seat. I don't know if you've ever heard that saying, but it means they're doing just fine, thank you very much, with handling their debt. So what happens? Instead of using, so we got to go back to the remember the 380,601 is our net income. We go back to where's the balance sheet? Come back. Go to the balance sheet and scroll down to the total stockholders' equity of $1.3 billion. So we divide that 380,601 divided by 1,329,383,893, and we get a return on equity of almost 30%, 28.79%. So you see, the more debt you have, right, it makes the return on equity look really good. And so, hey, everything's going great, assuming you can make the payments, because what happens if you can't make the payments? Right, you get, I was wrong, where are we going? You get hauled off to the bankruptcy court, right? And that's not fun. All right, so that was return on equity. Now, this particular statistic is similar. This is a measure of the overall profitability of a company in relation to both its debt and equity. And this one, you'll hear certain investors like to use this one instead of return on assets, instead of return on equity. And there's a few different versions of this. We'll use the easiest version, and they're very similar. The return on invested capital is used by many long-term investors, such as the famed Warren Buffett investor. However, there are a few different ways of calculating a return on investment capital, and we're using the most simplistic one. By using both long-term debt and stockholders' equity, the return on invested capital measures how well a company is managing all the capital that the company needs to earn its profits, because they needed the long-term debt as well as the stockholders' equity to actually earn the money. So you take any net income and subtract out any dividends, because the dividends, they went out the door. They went to the shareholders, and then divide that by the long-term debt and the stockholders' equity. So make sure you do the numerator first, then the denominator, and then divide. And what did I get? So plug in the numbers from these are from the income statement, and these are from the balance sheet. And I hope you're seeing that it's not that hard. You just got to find them on the two statements. And we've already found all these. Where are dividends? They're on the income statement. So let's go to I don't think Sprouts pays a dividend, right? I don't think they do. Go to the income statement. Income statement. Right, I don't think there's any dividend. Maybe, wait, are there dividends? I don't remember. Where are the dividends? No dividends, so we don't got dividends here. So, wait a minute. I think I'm getting confused. Yeah, no dividends. No, they don't pay dividends, so that's why it's zero. Right, I'm looking at my cheat sheet. There's no dividends. Okay, fine. So what did I get? What did I get? Go back to I got a return on invested capital of 13.39%. So you see, it's better than the return on assets, but it's much lower than the return on equity. Right. Okay, good. Excellent. Now, what's the next one? So those were the profitability ratios. So we're going to ask you in the assignment to do at least two from each category. Two common, which we did last presentation, two profitability, two of the next three groups. Okay, so make sure you do two of each, just because we don't want you to just copy all the common stock ratios from the internet. We want you to do a few. And you don't have to do all of them. The assignment has you doing just 12 of the, 28 or whatever there are. I forget what the number is, but you don't, because once you've done a few of them, it's pretty straightforward, folks. All right, now these are the liquidity ratios. These are pretty important for many investors, and I certainly want to know, if I'm going to invest in a company, can they meet their day-to-day operations? Do they have enough beer for the week? No, that's not what liquidity means. No, do they have enough cash to make payroll? Because if you can't pay your workers, that's a bad thing. Yeah, you can't pay the rent. Financial ratios that are concerned with the firm's ability to meet their day-to-day operating expenses and satisfy their short-term obligations as they come due. So there are three very important ones: the current ratio, the net working capital, and the acid test ratio. What a great name, acid test. It's also called the quick ratio. And we'll find that actually net working capital is the one black sheep of the family. It's not really a ratio, but let's continue. And these are all on the balance sheet. The current ratio, very popular, takes the current assets and divides them by the current liabilities. So in other words, okay, remember the current assets were the things that are going to be consumed within a year, and the current liabilities are the things we have to pay within the year. So if they are in balance 1-to-1, it means we can make our obligations, right? Anything above 1 is considered really good. Anything below 1, well, maybe we're getting in trouble here. If your current assets equal or exceed your current liabilities, you should be able to satisfy your short-term obligations without any problems. Obviously, the greater the number, the better, until you get to these tech companies that have current ratios that are in the hundreds, and you go, come on, guys, there's cash coming out of their ears. What are you going to do with it? And finally, some of the tech companies say, okay, let's start paying dividends. And they've been pretty darn good dividend payers over the last 20 some odd years. So let's now go to the balance sheet. Where's the balance sheet? There's the balance sheet. And take a look at our current assets. And they're $675,520,000. And our current liabilities, $679,000. So we should have a current ratio that is a little bit less than 1, right? Because we're taking 675,520 divided by 679. And I think my calculation is not right. I'm going to pause the presentation. And I'm going to take a look at my calculation. I think I might have made a mistake. Because remember, I make a lot of mistakes, folks. You got to check me. Yes, just eyeballing. I knew that my calculation was not correct. I fixed it. Okay, so we take the current assets, total current assets of 675,520, right? That's right off the balance sheet. And we divide it by the total current liabilities. And you can see they're very close to one another. But the total current liabilities of 679, 698 is a little higher than the total current assets. So what's going to happen is our current ratio is going to be below 1. See, if they were exactly the same, it would be 1. If the total current assets were greater than the total current liabilities, would be higher than 1, but it's going to be a little less. Now, not much less, 0.993. So, it's pretty darn close to 1. So, yeah, we can pretty much be assured that Sprouts can pay their current liabilities. And so the next one is a bit of an off, it's a bit the black sheep. It's not really a ratio. It's a subtraction. We take the current assets minus the current liabilities. And so the net working capital is not a current ratio. It's the current ratio in dollar terms. As we said, if the current ratio is greater than 1, then the net working capital will be positive because that means there's more assets than liabilities. If it's less than 1, then the net working capital will be negative, which means there's more liabilities than assets. And of course, the higher the net working capital, the better. It's not as popular, and as we said, it's really not a ratio, but it's often discussed when discussing the current ratio. In other words, how many dollars more do you have in assets than you have in liabilities, or vice versa. So now when we go back to the balance sheet, go back to the balance sheet, and we take 675,520 subtracted from the total current liabilities, it turns out we actually are a little negative, right? Oops, right? We only have $4 million. We have $4.5 million, $4.448, $4,448,000 more in current liabilities. But a company that's pulling in $7 billion in revenue and $380 million in net working capital, that's that's small. It's not that much, and they certainly have access to being able to make payroll. Now, okay, so that's cool, right? That's the current ratio and the net working capital. But many investors want to know a more stringent version of the current ratio. This is called the acid test ratio or the quick ratio. And so what this does is it pulls out the inventory. Now, there's two ways of calculating it. You add up the cash and the accounts receivable and the short-term investments and the other current assets. But the easiest way is to take the current assets and just subtract the inventory. And that's what I do, okay? It's just so much easier. You don't have to do 4 different calculations. You just do one. You take current assets minus inventory. So now, why would you do that? Well, think. Unlike the current ratio, the acid test ratio excludes inventory. This ratio measures the ability of the company to meet its short-term obligations, even if its current inventory becomes obsolete or undesirable, and hence difficult or impossible to turn into cash. And anything greater than 1 is certainly good. Now, think, what companies don't want inventory? Any company where the technology moves so fast that 6 months later the computer is obsolete, or the whatever the technology is obsolete. Cars, they don't they want they want the old inventory. Get it out of here. We want the new cars. But food, is I mean, it could go bad, right? But it's not as though the goods and services, the goods that Sprouts Farmers Market sells are going to become obsolete, or it's not. Hey, the food is the food, and people are going to want to buy it. So I'm not too worried about, in my humble opinion, as an analyst. And it turns out neither is Sprout's Family Market. Because if we go back to the balance sheet and take away, where'd the balance sheet go? We take away the inventory, which is $343 million from the total current assets before we divide by the current liabilities. And it turns out the asset test ratio is almost 0.5. It's 0.489. So in other words, yeah, if all of a sudden all the inventory in Sprouts became obsolete or undesirable, they'd have a hard time, right? Because that's $343 billion worth of merchandise. But that's not going to happen, barring meteorite, tsunami, earthquake, end of the world scenarios. So I think Sprouts feels very comfortable saying, hey, we're okay. Don't worry about us. And I think investors are saying the same thing because their stock has been on a tear lately. So let's go back to the presentation. And that was the asset test ratio. Simply take the current assets and subtract the inventory, or if you want to do the way that they have in the textbooks and the accounting manuals, go ahead and do that. But I like it's easier, just current assets minus inventory. All right, so those were the liquidity ratios. Now let's take a look at the activity ratios, sometimes called efficiency ratios. These are financial ratios that are used to measure how well a firm is managing its asset. So they are called turnovers. Accounts receivable turnovers, inventory turnovers, total asset turnovers. They use data from the balance sheet and the income statement. The activity ratios measure a firm's ability to convert different accounts within their balance sheets into cash or sales. Companies will try to turn their production into cash or sales as fast as possible because this will generally lead to higher revenues. In other words, get this stuff out the door, sell it. Come on, we've got new stuff coming in. And so the accounts receivable is a measure of how accounts receivable are managed. We take our total revenue, that top line number, and we divide it by the accounts receivable on the balance sheet. The higher the number, the better. It indicates the return a company is getting from its investments in accounts receivable. By maintaining accounts receivable, firms are indirectly extending interest-free loans to their clients. You know, we don't tend to think of this, but this is how businesses work. They sell the goods to the company, and then they collect the money later on. A high ratio implies that the company operates either on a cash basis or its extension of credit and accounts receivable is efficient. A low ratio that implies that the company should reassess its credit policies in order to ensure the timely collection of imparted credit not earning interest for the firm. In other words, the people I sold the materials for, they're not paying me on time. You know, they're supposed to pay me in 30 days or 60 days, and they're paying me 6 months later. And this is something that happened many years ago in the Defense Department because the Congress in the 1970s was pushing the Defense Department. Come on, we want you to deal with more small businesses, not just the big defense contractors. We want you to solicit business from small companies. And the Defense Department said, okay. So they went out to the what's going on with the it just disappears, doesn't it? Let's see if I can get it going. Start again? No, it's not starting. My apologies. The closed captioning just isn't working anymore. I don't know what's going on. So the Defense Department said, okay, let's see if we can get the small business involved. And so the small businesses said, sure, we want to grow our business. But then they didn't pay him for 6 months or 8 months. Uncle Sam does pay his bills, but he takes a long time. And the businesses were going, you can't do this to us. We don't have the kind of deep pockets that General Dynamics and Lockheed have. You've got to pay us or we can't make payroll. So my understanding, I haven't been involved in the Defense Department for a million years, but my understanding now is that they pay much faster. That's my understanding. Cool. Okay, so let's go get the total revenue off the income statement. That was that $7.7 billion. And then get the accounts receivable from the balance sheet. So let's go to the income statement. There's that 7.719290, the top line number. And then run over to the balance sheet. Here's the accounts receivable, 3,901. And so that's a pretty small number, right? They don't really do a lot of business to business work. They do mostly to consumers who pay right immediately. And so taking the total revenue divided by the accounts receivable, we get a huge number, right? 249. Yeah, right. So 249 times every year, the accounts receivable turns over. Pretty darn good. Yeah, it's because that's the way Sprouts works. They deal with the public more than they deal with other businesses. And this we're going to see is that their inventory turns over pretty quickly also. So we take again that top line number and divide it by the inventory. The higher the number, the less time an item spends in inventory, and the better return the company is able to earn from funds tied up in inventory. As with all these ratios, just to remind you, this ratio must be compared against industry averages. A low turnover implies poor sales and therefore excess inventory. A high ratio implies either strong sales or they're not doing a very good job of buying and maintaining their inventory. High inventory levels are unhealthy because they represent an investment with a rate of return of 0. And it also opens the company up to trouble in the case of falling prices or obsolete products. I mean, this is why computer companies don't have inventory anymore. Dell was the one that pioneered this. They designed computers, but they didn't build them until until the public said, I want that computer. Then they built it because they don't want the computer sitting around in a warehouse somewhere becoming obsolete immediately. And this is the car dealers, automobile sales people's nightmare. They want a lot of cars on the lot because that attracts people into the showroom, into the dealership. But they don't want a whole lot of cars on the lot because they're paying money to have the darn things there, and they're not making any money, and it costs them money to keep the inventory. So it's a balancing act. And so let's see the total revenue. That's that top line number, 7.7 billion, divided by the inventory. So let's go to the balance sheet. We said the inventory was what, $343 million, and we get an inventory turnover of 22.484. What does that mean? That means about every, 1.5 weeks? Not even, because there's 52 weeks in a year, 22 times a year, or 26 would be every week, every 2 weeks. So it's a little, like a little over 2 weeks. The whole inventory of Sprouts is turned over. So we go into a store and we see the shelves are all filled up. But no. In 2 weeks' time, all the material, all the stuff you saw in that Sprouts has been sold, and new stuff has taken its place. Now, some things, every day they're always redoing milk and Pampers and things that sell quickly, and other things may stick around for a couple months, maybe seasonal stuff and the like. But in general, that's how fast they're turning over their inventory, every about 2 weeks or so. Cool. Okay, back to the next one, which is the total asset turnover. Now, this one's going to be a whole lot smaller because we take the top line number and we divide it by the total assets. The total asset turnover ratio measures the firm's efficiency at using assets to support the sales and revenue. Obviously, the higher the number, the better. Some companies have low profit margins. They tend to have high asset turnover. And those with high profit margins certainly tend to have low asset turnover. Well, we've got $7.7 billion in revenue and about 3.6, as I remember. Let's go look at that balance sheet again. It was like 3.640 total assets. And it turns out that they're turning over the total assets of the company twice a year, every 6 months or so. At 2.12 is what I get. What do you get? Check, make sure. I make mistakes, obviously. Cool? Okay. Not as important as certainly I think the inventory turnover is something a company and investors should be watching very carefully. All right, now the solvency ratios, these leverage ratios. These are ratios that are used to measure the amount of debt being used to support operations and the ability of the firm to service its debt. Oh yeah, we don't want to be hauled off to bankruptcy court. There's the debt to equity times interest earned, one of the very, very popular financial ratios of Warren Buffett's teacher, Mr. Benjamin Graham. And when you eventually read the Intelligent Investor, you will see the master at work using times interest earned. Total debt to total assets and total debt to capitalization. We use the balance sheet and the income statement. Now, you're going to hear this term leverage, and we're going to come back to it throughout the rest of our journey together. Data is often referred to as leverage. The idea is that you're using other people's money to make your money. Does that sound familiar? You're using borrowed money as a lever to increase your earnings. When one firm buys another firm using borrowed money, it is often referred to as a leveraged buyout. Right. They're borrowing a ton of money to buy that company. Now they're hopefully doing their homework, and they're saying, I'm going to be able to pay off that. I'm going to be able to service that debt. I'm going to be able to pay the interest and pay the debt when it comes due. Right. Because if you don't, right, you're in trouble. You're looking at bankruptcy, not something you want to go through. So here are the debt to equity. And this might look familiar because these are a couple of the types of ratios that we did in the BUS123 Principles of Money Management class, but we did it on our personal level. Now we're doing it on a corporate level. This is a measure of a company's financial leverage calculated by dividing the long-term debt by the shareholders' equity. It indicates what proportion of equity and debt the company is using to finance its assets. So we take the long-term debt, we divide it by the total stockholders' equity. A higher debt to equity ratio generally means the company has been aggressive in financing its growth with debt. This can result in lower earnings because we get to write off the interest payments and hence lower taxes. Sometimes investors use total liabilities instead of long-term debt. In my humble opinion, the lower the better for more risk-averse investors. Some people who are very worried about debt. As I think I've told you, my motto throughout my life has been make love, not loans. Something my father taught me. But when I told him that, I lived by that, he said, it's a joke. I don't know anybody. He never did it. But I done it. And I think it's a much better way of going through life. But everyone's different, right? I had a couple people yell at me at a party once, very wealthy individuals, saying, "Oh, you're out to lunch. You should be racking up as much debt as you can. You want to die with as much debt as you have." The problem with that is you don't know when you're going to die, right? If you knew the day you were going to die, sure, run up with 30 credit cards to the maximum. Right. Okay, let's get back to the issue here, Payano. And so let's go to the balance sheet, take that long-term debt. Where's that long-term debt? There it is, 1.52 billion, and divided by the stockholders' equity of 1.321, right? And it turns out that they have over 115%. 1.15, is that what you get? That's what I got. Yeah, that's scary. They have more debt, long-term debt, than they have stockholders' equity, ownership of the company. Ooh. That to me is scary. Not to worry. Wait till you see. Sprouse is not worried. Their company, their management is saying, don't relax, don't worry about it, because what we're going to see is they can deal with that debt no problem. Times interest earns. So this is the measure of the ability of the company to meet its fixed interest payments. We take that earnings before interest and taxes and divide it by the interest expense. So the earnings before interest and taxes and interest earnings, they're on the income statement. And it's what we're doing is we're calculating how frequently the company earns the interest throughout the year. The higher, the better. So in other words, how many times in the year have you earned your interest payments to be able to pay them. And 3 or 4 is considered adequate. Well, wait till you see. Let's go back to the income statement. And so where is their earnings before interest and taxes? $504 million. And in the previous year, they paid almost $6.5 million. The year before that, $11 million. This year, they actually earned interest. Net, because they have a bunch of cash and they're making money off the cash. So, so they actually wound up with a positive interest payment this year. Yes, Sprouts is not worried about being able to make their interest payments. So it's actually a negative 229, which is ridiculous. But, the year before, it was like, I don't know, 20 something. In other words, every couple of weeks, they were earning their interest payments. Think about it, folks. That means if it were you, in a couple of weeks' time of working your job, you were making all the interest payments for your mortgage that year. Not bad, right? Not a very, very enviable position for Sprouts to be in. But that's not going to last, right? Because they're going to spend that money and they're going to use it to open new stores throughout the country. They're moving into new states. And so, so that money is going to be eaten up. And they're going to wind up, but they're still spending, just a few millions, maybe between $6 and $11 million on their interest, so they can make their interest payments. Sprouts is not worried about being hauled off the bankruptcy court. And then the total debt to total assets takes the total liabilities and divides it by the total assets. And this is something that we did in the Principles of Money Management class for us individuals. Total debt to total assets includes both the short-term debt and the long-term debt. It varies substantially from the debt to equity ratio. If it varies substantially, then the company may be relying heavily on short-term debt, which can be problematic. In other words, they're making their mortgage payments with their credit card, right? They're using short-term debt as opposed to long-term debt for long-term assets. And so we'll do the total liabilities and total assets. And again, it's going to look not so great for Sprouts, but they don't have to worry. So if we go to the balance sheet, go to the balance sheet. Total debt was $2.3 billion. Total assets was 3.6. And what do I get? Total debt, like 64%, 63.69%, which again, to me is a little high for me personally. It's not the way I'd want to run my household's finances. But Sprouts is in a growth mode. They need that money to build out, and they're doing just fine. Thank you very much. So it's, I wouldn't say people who customers who go to Sprouts are as enthusiastic as they are when they go to Costco. I mean, Costco customers just love Costco, but Sprouts customers seem to be very loyal, and they're more educated, more female, and they're looking for more healthy foods. So I think Sprouts is going to do pretty darn good. Okay, so 63% there, but now let's take a look at the very last one, which is a measure of the total amount of outstanding company debt as a percentage of the firm's total capitalization. So this one is a little bit more subtle. It's very similar to the one we just previously did. But we take the short-term debt and the long-term debt, and we divide it by short-term debt plus long-term debt plus stockholders' equity, what often is referred to as the capitalization. In other words, what resources do you need for this company to be in business? Similar to the total debt to total assets ratio, as with the other ratios, obviously the higher the debt level, the more risk of insolvency. However, some industries with high debt rates of debt, such as utilities, also have more reliable earnings. As always, we must compare our results with the competitors in the industry as a whole. So you know where to find all these guys, right? Short-term debt's on the balance sheet, long-term debt's on the balance sheet. And these are on the balance sheet, short-term debt, long-term debt, shareholders' equity. And I get 55.85%. No, check me out. Make sure I get it right. I don't know, I make mistakes. It's a little less than the total debt to total debt to total equity, but it's still up there, over 50%, 55.85%. Still awake, folks? I know it's tedious, but once you've done a few of them, they're pretty darn straightforward. Create a spreadsheet to just type in the numbers from the balance sheet and the income statement, and boom, boom, boom. The computer will do the calculations for you, but it's very easily done with a calculator, 99-cent calculator. And what these, again, I'm going to reiterate, I apologize for saying it over again. We do this to round out our investigation, our research of companies. Thinking of it, I think of it, if this helps, fine. If it doesn't, don't worry about it. I think of it as a stew of information that we can use to compare the company against its competitors, the market as a whole, and the industry they're in. And there's no one ratio, but sometimes a ratio will raise a red flag to means we have to do more research, and then maybe it does lead to a purchase or a sell or whatever. Okay, so we've done the heavy lifting with regard to stocks. We're ready now to begin the descent on stocks to more, easier stuff to think about, fewer calculations, and a little bit of silliness and psychology we'll deal with in chapters 6 and 7. Thank you so much for being in our class. The assignment, as we said, is to do these calculations for 2 or 3 companies. Try large companies. And you don't have to do all of them, folks. You do 12 out of the, whatever it is, 28, whatever they are. And try to stay awake when you're doing it. Dear, well, how was your day at work? And remember, the more accounting you know, the easier it will be to understand the information that you're and digest the information that you're generating. Again, thank you so much for being in our class. See you in our next presentation when we ask, who can beat the market? Turns out some people can.